Welcome to the deep dive. Today we're cracking open the world of tax.
Specifically, how profit and income get figured out, right? Based on that story layer 2 material you shared.
Exactly. And let's be real, tax stuff can feel like a bit of a maze sometimes.
Definitely. But our goal here is to, shed some light on the key ways it's all calculated. Make it clearer.
Yeah, make it make sense, whether you're running a business, maybe you're self-employed, or honestly, even if you just want to understand the basics of income tax.
Right. These principles were pretty fundamental. What we're going to unpack from the source should give you some really useful insights.
So the mission today, pull out the core ideas on profit and income determination from this text, make them understandable.
Let's do it. Clarity, not just repeating rules.
Okay, so where do we start? The material kicks off saying how you figure out income depends. Depends on whether it's profit income or surplus income.
That's the first big split.
What's the practical difference there?
Well, think of profit income usually coming from, say, ongoing business activities. You're probably tracking things more formally, maybe with accounting software.
Okay.
Surplus income is often simpler, more like income from specific sources, like renting out a place or maybe some investments, minus the direct costs tied to that specific income.
Ah, okay. So that basic difference then dictates which calculation methods you actually use.
Precisely. It sets the path.
Got it. So let's talk profit income first. The text lays out 3 ways to figure it out under the Income Tax Act. Method 1, comparing business assets. Section 4, paragraph 1.
Right. Now, who uses this? Mainly businesses that are legally required to keep detailed books and prepare, formal financial statements. Think larger companies?
But not only them.
No, exactly. If you run a smaller operation but you choose to keep really comprehensive books, you can opt for this method too.
Okay. And the idea is looking at the net value, the assets, at 2 different points in time.
That's the core of it, yeah.
Yeah.
You see how the operating assets change between the end of the financial year and the end of the previous one?
Right. And then you adjust for money the owner took out or put in.
Correct. Withdrawals get added back to the difference, and deposits get subtracted.
It's like checking the business's financial health at 2 dates, but accounting for the owner's personal transactions with the business?
Perfectly put. The example in the text makes it pretty concrete.
Yeah, let's walk through that. Business assets, end of 2021, 80,000. End of 2022, 170,000.
Okay, so an increase there.
Then during 2022, withdrawals were 40,000 and deposits were 5,000.
So the calculation is 170,000 minus the starting 80,000.
That's 90,000 increase in assets.
Right. Then add back the 40,000 withdrawal.
Gets us to 130,000.
And finally subtract the 5,000 deposit.
Leaving $125,000. That's the profit for 2022 using this method.
Exactly. It's a comprehensive look at the change in the business's overall value.
Okay, clear enough. Method 2 then, the surplus calculation. Section 4, paragraph 3. This sounds different, aimed elsewhere.
Yeah, this one's generally for taxpayers who aren't legally required to keep those detailed books. Think freelancers, small professional practices, maybe some smaller traders.
And the calculation itself sounds simpler.
It is, generally. You just take your operating income, the money coming in from the business activity, and subtract your operating expenses.
Straightforward. Income minus costs.
Pretty much. The example given is, I think, a doctor's office.
Yeah, $370,000 in operating income.
And $95,000 in operating expenses.
So $370,000 minus $95,000. That gives a profit from self-employment of $275,000.
Correct. It really focuses just on the cash flow related to operations during that period, less about overall asset changes.
Gotcha. Very different focus. Now, the third method mentioned, Section 13A, profit based on average rates. This sounds really specific.
It absolutely is. This method is almost exclusively for farmers and foresters who meet certain, quite specific requirements.
So instead of tracking every euro in and out,
they can sometimes use standardized average rates, provided by the tax authorities, to figure out their profit. It simplifies things quite a bit for certain agricultural businesses that fit the criteria.
Interesting. Good to know there are specialized paths like that. Okay, but what about that second method, the surplus calculation? What if someone using that doesn't, keep good records of their expenses?
That's a crucial point the text makes. If you can't properly document your business expenses for that surplus calculation,
You can just make them up, right?
definitely not. The rule is your profit then have to be estimated. And the estimation method used goes back to the first method we discussed, the comparison of business assets.
Wow. Okay, so even if you're eligible for the simpler surplus method, you still need proof of expenses. Otherwise, they default to the more complex asset comparison.
Essentially, yes. It highlights the importance of record keeping, even for simpler methods. No proof, they look at the bigger picture of your assets.
Makes sense. Okay, let's shift to the time frame. The period for calculating profit, the financial year. It's not always just January to December, is it?
That's right. The financial year is just the period a taxpayer regularly uses to calculate their profit. It can be the calendar year, but it doesn't have to be. Depends on the taxpayer.
Okay, and the text breaks this down. For farmers and foresters, it's usually different, right?
Yep. Generally, their financial year runs from July 1st to June 30th.
Which obviously spans 2 calendar years. So how does the profit or loss from that period get taxed?
They split it. It's called a time proportionate allocation. The profit or loss from that July to June year is divided evenly between the 2 calendar years it touches.
Okay, so the example. Profit 2021-2022 was $80,000. Loss 2020-2023 was $50,000. How does that affect the 2022 tax year?
Right. For 2022, you take half of the 2,122 profit, which is 612ths of 80,000.
So 40,000 profit attributed to 2022 from that period.
Correct. And then you also take half of the 22-23 loss, which is 612ths of 50,000.
Which is natural 25,000 loss attributed to 2022.
Exactly. So the net result for the 2022 calendar tax year in that specific example would be 40,000 minus 25,000.
A profit of $15,000 for tax year 2022. Got it. That split makes sense for aligning it. Now, what about traders, like regular businesses? The rules seem different depending on if they're registered.
That's right. If a trader is registered in the commercial register, usually meaning they're a more formal business entity, their financial year is whatever period they normally use for their own financial statements.
So it could be, say, February 1st to January 31st.
Absolutely. The example shows exactly that. A profit made from Feb 1, 2021 to Jan 31, 2022, €80,000, counts entirely towards the 2022 calendar tax year.
Because the financial year ended in 2022.
Precisely. And similarly, profit from Feb 1, 2022 to Jan 31, 2023, €70,000, would be taxed in the 2023 calendar year.
Okay, so the end date is key for registered traders.
Yep.
What about traders who aren't registered?
Much simpler for them. Their financial year is always the calendar year, January 1st to December 31st. No exceptions mentioned there.
Good distinction. And one last point on this. Changing your financial year requires tax office approval.
Yes. You can't just switch it up whenever you feel like it. You need permission, likely need to show a good business reason. It's an administrative step.
Right. Prevents gaming the system, I suppose. Okay, let's switch back to that other category. Surplus income. We know the types, but how's it calculated?
It's generally simpler, as we touched on. For income types 4 through 7, rental, investment, other miscellaneous income, you typically just subtract the related expenses, what they call Verbundskosten, or business advertising expenses, from the income received.
And that's it. No other methods like with profit income.
Nope. The text is clear on that. For surplus income, it's income minus expenses. That's the only way mentioned.
Okay. And if those expenses are actually more than the income for that year?
Then you have a loss for that income type. Depending on the specific rules for that type of income and loss, you might be able to offset it against other income or carry it forward or back to other tax years.
Makes sense. Now, the period for surplus income calculation, does that follow the potentially flexible financial year rules?
No, this is another key difference. The determination period for surplus income is always the calendar year. Always January 1st to December 31st.
Even for income from self-employment, if you're using the surplus method?
Yes, even then. The text emphasizes this. Calendar year applies across the board for surplus income determination.
Okay, that consistency is helpful. Now, this next part seems really important. The timing. When do you actually count the income and expenses for surplus income, the temporal allocation?
Right, this is crucial. It works on 2 main principles. Receipt and outflow.
Receipt principle first.
Yeah. Income is counted in the calendar year when you, the taxpayer, gain economic control over it. Basically when you actually get paid.
So cash in hand or money hitting your bank account.
Or when it's used to offset a debt you owe or even just credited to your account, even if you haven't physically accessed it yet.
And if someone you authorized, like an agent, receives it for you.
That counts too. The text also mentions specific rules, like for checks and bills of exchange, about when they are considered received. It's about economic access.
So it's not necessarily when you earned it, but when you can actually use it.
That's a good way to put it. And the outflow principle for expenses is the mirror image.
Expenses count when the money leaves your control?
Essentially, yes,
Yeah.
when the monetary value leaves your assets. So when you hand over a check or for a bank transfer, generally when the transfer order reaches your bank, assuming the funds are there.
Ah, the textbook example was good here.
Yeah.
Transfer order given to the bank in 2022, but it wasn't actually processed until 2023.
Right. But the expense is still considered paid in 2022 because that's when you initiated the outflow, when you gave the irrevocable order.
That timing around year end can be tricky. Okay, now what about things that happen regularly, like rent or interest payments? There are special rules.
Yes, for regularly recurring income and expenses, there's a modification to the simple receipt outflow rules, involving what the text calls an attribution principle and a short period rule.
Okay, how does that work for income, like rent?
So the general idea for regular income is that it's allocated to the year it economically belongs to, usually the year was due or payable.
But there's an exception, the short period rule.
Exactly. If the income is actually received within a short period, specifically 10 days before the end of the year it belongs to, or 10 days after the start of the next year, it still gets attributed back to the year it economically belongs to.
Let's use the rent example. December 2022, rent is due December 31st. If I get it on, say, January 6, 2023.
That's within 10 days after the year ended, so it's still counted as 2022 income.
But if it arrives on January 17th, 2023.
That's outside the 10-day window. So even though it was for December 2022, the receipt principle kicks back in, and it becomes 2023 income.
Okay, and the other way. January 2022, rent due Jan 1st, but paid early, say, to 22nd, 2021.
That falls within 10 days before the start of the year it belongs to, 2022. So under this rule, it's attributed forward to 2022 income.
So that plus 10-day window around the year end is key for regularly recurring income and interest.
Same logic. The example. Interest is credited to your account day 31, 2022. Doesn't matter if you don't see it in your passbook until March 2023.
It's 2022 income because that's when you economically got access to it, when it was credited.
Exactly right.
Does this same short period attribution apply to regularly recurring expenses like insurance?
Yes, it does. But there's a crucial extra condition. For expenses, the payment must happen within that plus-minus a 10-day window, and the expense must also be due within that same short period around the year end.
Ah, okay, so both the payment date and the due date have to be close to the year change.
Correct. The insurance premium example illustrates this perfectly. Premium is due Jan 1, 2023. You pay it early on day 27, 2022.
Payment is within 10 days of year end.
Yes, but the due date is January 1st, 2023, which is not within 10 days of the end of 2022. It's in the next year.
So because the due date is firmly in 2023.
The expense is attributed to 2023, even though the cash outflow happened in 2022.
That's a really important distinction. Both payment and due date need to be in that tight window relative to the year the expense belongs to.
It prevents shifting deductions too easily just by paying slightly early if the obligation itself isn't due around year end.
Got it. One last specific rule mentioned. Advance lease payments covering more than 5 years.
Right. If you pay rent or a lease payment way in advance for a period longer than 5 years, you can't just deduct the whole chunk in the year you pay it.
We were spread it out.
Exactly. The expense deduction has to be distributed evenly over the entire lease period it covers. It aligns the expense recognition with the period that benefits from the payment.
Okay, that makes sense from a matching principle perspective. Phew, that was quite a bit.
It definitely covers a lot of ground, but breaking it down helps.
Yeah. So just to recap the big themes,
Yeah.
the key distinction between profit income and surplus income determination.
The different methods for profit asset comparison, surplus calculation, and those average rates for farmers.
Understanding the financial year concept, how it can differ, especially for registered traders versus others, and that split for farmers.
And then those really specific timing rules for surplus income, the receipt and outflow principles, and that special 10-day rule for regularly recurring items.
Absolutely. I think understanding these fundamentals from Steuerlehre 2 really is key, like you said, for navigating income tax.
It provides the framework. Knowing if you're dealing with profit or surplus income sets the stage, and then the timing rules are critical for getting the numbers right each year.
So as you, our listener, reflect on this, maybe think about how these rules apply to your own situation. Could the choice of financial year, if available, or even just careful timing of income or expenses within these rules make a strategic difference.
Yeah, what other questions does this raise for you about how tax planning intersects with just, regular financial reporting? Definitely something to mull over.
Absolutely. Well, thanks for joining us for this deep dive.